Hi, I'm Professor Bei Dong from USF School of Accountancy. In this video, we're going to talk about those techniques used by companies to disclose additional information. Those additional informations are very important. They provide detailed explanation of those line items on the financial statements. There are 5 techniques commonly used by companies to disclose additional information. First one, parenthetical explanations. Second one, notes. Third one, cross-reference. Fourth one, control or adjunct accounts. Number 5, supporting schedules. And we're going to talk about them one by one. The first one is parenthetical explanations. This one provides very direct, simple, easy, parsimonious explanations of those line items on the financial statement directly on the body of financial statements. So for example, look at here. This is a Lucent Technologies partial, income statement. And this line item is called cumulative effect of accounting changes. In this bracket, they talk about that this number is net of income taxes of 842 actually millions of dollars, which means that the number you see over here, 1308 millions of dollars, that is a net of tax effect number. Okay, so which means that the tax effect is 842 millions of dollars. The second technique is notes, or you can call it footnotes. They usually provide more detailed explanations, paragraph after paragraphs, with those supporting schedules after financial statement for something like accounting policies this particular company used, assumptions they made, and the methods they employ. For example, this is Intel Corporation's footnotes to their consolidated financial statement in terms of the inventory. So in this footnote, in this little paragraph over here, they talk about that inventory cost is computed on the currently adjusted standard basis. The inventory method they use is approximate to their average or first in, first out. So this is about the inventory method they use. And also the ending inventory is valued at the lower of the cost or market. So this is about the accounting method they use. And also in this footnote, they provide this little schedule, explaining the raw materials, working process, and finished goods, contained in this total inventory numbers. So this is a manufacturing firms, so that's why they have all these 3 inventory accounts. The third technique here is called cross-reference. Simply speaking, cross-reference just tell you the relationship between the asset and the liability account on your balance sheet, of course. So let's see this example. This particular company A, they have a notes payable in their current liability to be redeemed in less than 12 months. And also this company has created a cash account with the financial institution to fund this $100,000 notes so that it will be able to pay off those notes within 12 months. So there's a direct relationship between their current asset and their current liability, and particularly this part of $100,000 in the cash and this $100,000 of notes. So there's a direct relationship between these two accounts. So they actually use this cross-reference on the body of the balance sheet to tell you that there's a direct relationship between these two accounts here. The fourth technique is this control or adjunct items. Contra account means decrease. Adjunct accounts means increase in asset, liabilities, or shareholders' equity. For example, let's see this accounts receivable. Accounts receivable for this particular company is $1 million. That means that this company, expecting to receive $1 million. However, there's a line item immediately after this accounts receivable is this allowance for doubtful accounts. This account tells people that this particular manager, they estimate that $400,000 out of this $1 million may not be collected. This is doubt. Okay, which means that using $1 million minus $400,000, the net realizable value of this accounts receivable is $600,000. That means at this time point, the manager still believes that $600,000 of this $1 million accounts receivable will be collected in the near future. The last technique we're going to talk about is the supporting schedule. For example, this particular company. On the face of the balance sheet, the number you're going to see is this $33.20 million related with a long-term asset, property and equipment. However, we don't know what's in that number. The supporting schedule in the footnote will tell you that, okay, of this $33.20 million, some of them are land and buildings and leasehold improvement. Some of them are computer equipment related softwares. Some of them are production engineering, other equipment. We also have operating lease asset and also have furniture and fixtures. So they provide you a detailed explanation of the numbers they show on the balance sheet.